All right, let's dive into a corner of the investing world that honestly doesn't get nearly enough attention. We're talking about something packed with some really unique advantages. We're talking about preferred stock. So let me ask you a quick question. When you hear the word stocks, what pops into your head? For most people, right, it's all about buying shares in some big tech company and just hoping the price goes to the moon. But what if I told you that's only one side of the coin, that there's this whole other kind of stock out there? Well, that's where preferred stock comes in. You can think of it like a hybrid vehicle of the investment world. It's got a bit of the safety and stability you'd expect from a bond, but it also has some of the growth potential you get from a common stock. It's not as, safe and slow as a bond, but it's definitely not the wild ride that common stock can be. It really does sit in this fascinating sweet spot right in the middle. Okay, so because it sits in that middle ground, it forces you, the investor, to make a really fundamental choice. And it all comes down to this classic trade-off. Are you looking for stability, or are you chasing that explosive growth? Let's dig into what that actually means for your money. First things first, let's talk about power versus perks. When you own common stock, you get a seat at the table. You get voting rights. You actually have a say in the company's future. With preferred stock, though, you usually give up that vote. But in exchange, you get some pretty sweet perks, specifically a higher place in the financial pecking order. Okay, next up, how do you actually get paid? With common stock, it's pretty much all about growth, right? You're betting on the stock price going up, hopefully way up. That's your home run. But preferred stock, it's a totally different ballgame. It's all about income. It's built to deliver a fixed, super predictable dividend. Seriously, it's almost like getting a steady paycheck from your investment. And that difference in how you get paid leads right into the next big thing, risk. Look, we all know common stocks can be an absolute roller coaster. The price can just swing like crazy based on an earnings report, a single piece of news, or just what the market feels like that day. Preferred stocks, on the other hand, are way, way more chill. Their price is much more stable because it isn't really caught up in all that day-to-day company drama. It's influenced more by big picture stuff like what's happening with interest rates. So when you strip it all away, it comes down to this one core idea. You are making a conscious choice. You're sacrificing high growth for stability. That's the deal. You're trading that potential lottery ticket win from common stock for something much more predictable, much more reliable. So I keep throwing around words like safety and stability, right? You're probably wondering, okay, but why is it safer? What's the secret sauce? Well, it's not a secret at all. Let's break down the 3 pillars of safety that make preferred stock a more secure play. So you can think of it as a 3-layer shield protecting your investment. First up, you're first in line for dividends. The company has to pay you, the preferred shareholder, your promised dividend before the common shareholders get a single penny. It's a rule. Second, you have a priority claim. Let's say the worst happens and the company goes belly up. When they sell everything off, you get paid back before the common shareholders. Now, bondholders are still first, but you're in that crucial second spot. And third, like we just talked about, is that lower volatility. Fewer sleepless nights watching the stock price jump all over the place. And, when you see it visually, the difference is just stark. Common stock prices can look like a heart rate monitor during a horror movie. Huge spikes, deep valleys. The journey with preferred stock, though, it's designed to be a much, much smoother ride. But hold on, it gets even more interesting. Preferred doesn't just mean one thing. You can kind of think of it as meaning special, because not all preferred stocks are the same. They come with all sorts of different features and rules baked in, so you've got to read the fine print. Let's peek under the hood at a few of the most common types. Okay, let's just touch on 3 big ones you'll see. First, you've got cumulative preferred stock. Now, this is a fantastic feature for investors. It means if the company hits a rough patch and can't pay your dividend one quarter, they still owe it to you. It accumulates. They have to pay you back all the missed payments before common stockholders can get paid again. Then there's convertible. This one's cool because it gives you the best of both worlds. You get the option to convert your preferred shares into a certain number of common shares. So if the company suddenly takes off, you can flip a switch and ride that growth wave. And last, you have to watch out for callable stock. This gives the company the right to buy your shares back at a set price. This is a risk because they'll probably do it when it benefits them most, like when interest rates have dropped, leaving you to find a new home for your money at a lower rate of return. All right, we've covered a lot of ground. So now we get to the million-dollar question, right? The only one that really matters. Is any of this a good fit for your portfolio? Let's wrap this all up and get to the final takeaway. So here's the bottom line. Preferred stocks really shine for a certain kind of investor. We're talking about someone whose main goal is generating stable, predictable income. Someone who's not trying to get rich overnight and who's okay with a medium amount of risk. A perfect example? Think about someone who's getting closer to retirement. For them, a reliable cash flow, that paycheck, suddenly becomes way more important than swinging for the fences with a high-growth stock. So, as you're weighing the options, keep these key points in mind. On the plus side, preferred stocks can be an absolutely killer defensive play when the market gets choppy and uncertain. They provide that stability. But on the other hand, when the market is in full-on bull mode and everything is soaring, you're going to feel that limited growth potential. You'll be watching from the sidelines. And one last thing to remember is something called liquidity risk. Basically, because not as many of these shares are traded every day compared to common stock, it might be a little trickier to sell your position quickly if you need to, at least without nudging the price. And that really brings us to the final and most personal question of all. It's one only you can answer. You have to look at your own financial goals, where you are in life, and honestly, how well you sleep at night when the market is volatile. And then you have to ask yourself, in my own strategy, what is stability really worth to me?